Cloetta, I will be much shorter on Cloetta because I think the aim was more also to explain the overall mechanism on how we look at businesses. Here we have again on the same metrics, we have Cloetta measured in terms of quality score and value score. Quality score is for us composed, the underlying, what is a quality score? Huh? Quality for us means highly profitable, stable businesses. It's really increasing, preferably their return on equity over time, their return on invested capital. We have a whole series of measures we look at. Why are we using so many measures? Because we think that if you use a quantitative tool, if you just use 1, 2, 3 measures, you are so dependent on one measure that if we use a larger set, we get maybe a better quantitative understanding of what the business delivers. In the same way you analyze the performance of a fund manager in more details, you look at factors, maybe you look at different things, we try to decompose the quality of the company. It's difficult to come to the earning power or to, we are not measuring the earning power only with numbers. It's the due diligence process that gives us the earning power. And then the value score, we use a methodology also with different ratios. We prefer not to be too dependent on earnings estimates. So we look at what has the company really delivered. We see the stock price as it is today. We try really to also there to look at different measures in order not to become hostage of only one factor like PE or EV to EBITDA. Here in the case of Cloetta, same exercise, Cloetta pops out well in the universe, not only of food products, but food, beverage, and tobacco, consumer staples. So Cloetta is actually, well, a very boring but interesting business, and we like that. They are active in chocolates, they are active in candies, in nuts, pastilles, chewing gum, pick and mix. Their main markets, they have extremely strong positions in the Nordic countries. While we here in Luxembourg, we know Läkerol made it to Luxembourg, but the other brands are probably little less known for the non-Nordics. It's a profitable business. It has some leverage, and we come back to why it has this leverage, because the business has been expanded. It has 2,500 employees. I think the underlying drivers of this business, well, that's a summary we put in there is a slogan from Cloetta, everybody has munchy moments. I think it's really a business that is developing. They have very strong brands. They get a presence with retailers. It's a non-cyclical business, of course. It's actually a little anti-cyclical. I notice with myself, the more volatile markets get, the more chocolate I eat. We have improving capacity utilization of the factories, self-help, cost efficiencies, and we have a business that should be slightly growing going forward. Here again, the 8 steps, starting with ESG analysis. I will not now go into detail of each step because I also wanted to spend a couple, 2-3 minutes on Europcar. But I think what I find particularly attractive is here again, like in the case of Krones, you have market-leading positions, and you have a company, if I would summarize it, that needs to digest some of the things it had made in the past. They had made different acquisitions. They have, for example, acquired this pick and mix category, which makes sense, but they now are in the midst of integrating this. They also had, unfortunately, they had a fire at one of their factories recently. That's impacting them. So their operating environment is a little bit more difficult. You also see there's a clear shift, of course, to less sugar products. Will it continue? I don't know. But they try also, of course, to adapt slowly to this. And they have been also a little bit negligent in terms of marketing spending while they were focusing on doing their acquisitions. I believe that will now change with further investments in marketing. Solid management, and you have here in this case a new CEO, whom we have not met yet, I must precise, who came in 2017 and tries to relaunch a little bit the company, give a new dynamic. I think it looks very good for such a stable business if you translate this and our whole modeling, which I'm not going to detail now. If you look at the free cash flow yield of that company, it's above 7% according to our numbers, our measures on earning power. I think it's really a company in transition and with a very stable business with market-leading positions. So that's something some may find boring, but we find it very attractive in today's markets. And then Europcar. Briefly, an update. I made the case for Europcar last year, and the case is based on actually also, again, a market-leading position, a company that actually rental markets that's completely different in Europe than it is in the US. You have actually quite an oligopolistic, you have 3 players actually controlling the market, with Europcar being the biggest one, and you have a company that has invested, that has done acquisitions to go more in the low-cost area, like they acquired, you may recall, Goldcar and Buchbinder. And the company, again, as with Cloetta, is digesting a little bit what it did in the past. And I think also the company is still profoundly misunderstood. Because if you take their rental fleet, one of our major assumptions is that, and we have proven, the company is saying this, that they can sell back to the OEM the cars. They can, more than 90% of the fleet can be sold back at a prefixed price after a couple of years to the OEMs. That makes them, puts them in an excellent position, but that also means that a lot of the debt you see on the headline figures is closely tied, is actually a little bit more working capital and is closely tied to this debt. So our case is still intact. The market has not recognized it, but that's what value investing is also about. It's still one of the top 10 positions in the fund. We are committed because we think that the company is on a good track. 2018 is a transition year as they continue to digest what they did in the past. However, if you would have run out of the EV conference last year and bought the stock, you would probably have bought around 10, I believe, and while we are now around 8 euros. So that's the story in Europcar. Yeah, and maybe quickly the disclaimer, which is further beyond. Because I heard I need to show it. Okay. So, any questions?
That's a killer for any Q&A. Yeah.
Yeah. Hi. Thank you for the presentation. So, in both cases, when you were talking about a particular company, there was your screening criteria had dots that at least looked just as a dot more attractive on the value and quality and value. Are those companies in the portfolio, or they get rejected because of the qualitative analysis?
No, I think what is very important to say is that the screening is just a little bit like a gardening tool for us. It's just a tool. And I think now over the years this tool has evolved, this gardening tool has evolved in becoming a very solid and good tool. It points our attention towards certain companies which could potentially be interesting. It doesn't mean that, that they will make it through the due diligence. I think the screening, that's if our investment style would just be about the screening, we would have a lot of leisure time because the essence of what we are doing are the 8 steps and the valuation model. So it's a fundamentally different process, and you have some names that will score very, very oddly and very bad on this matrix. Because if I go back and I gave the example of Europcar, while we of course plot our existing portfolio on these scores, and actually in terms of quality score, Europcar scores very low. Why does it score low? Because they are in the midst of doing this integration of Buchbinder and Goldcar, and second, because the debt is a debt that is very high on the surface, but it's part of our investment case that it's around 4 billion on the surface. I think it was in end of 2017. That actually a lot of this is tied to the fleet and is not a risky debt. So relying only on a quantitative tool would not always be so helpful in our approach. But I think, and we believe that it has become quite a powerful tool.
One second, I'm coming to you with the microphone.
One question regarding the exit of Drive Now and the competition from car manufacturers that getting more pressure. And the second is the relative value to Sixt. Why is it regarding sales and other metrics much cheaper? And yeah, that's mainly like.
Okay. So the competition from the OEMs. Well, if you are an OEM, you are often also being called a mass market producer. What counts, what the managers at Volkswagen or the big producers are being paid on is the number of units they sell. What happens if Europcar is one of their biggest clients? So they need Europcar, they need, and they are so important in their, it's also a matter of capacity utilization in their factories. They want actually to have to maintain Europcar as a client very happy. So I'm not seeing this as a big danger, and that's why also, by the way, the OEMs, they are so forgiving and telling them that 90% of the cars you buy, we buy them back at a prefixed price. So it's actually a situation where Europcar could be in a kind of a sweet spot because they are the biggest in an oligopolistic market. So that's one thing. The other thing is that actually Europcar sold some activities back to the car makers last year to focus more on the rental part. Maybe you want to give a comment.
For me, I add one thing. The biggest client of all auto manufacturers in Europe is Europcar. If you are an auto manufacturer and you want to gain market share, you need Europcar as a client. This buyback model, Léon said that they could deliver them back after 2 years. That's actually not true. It's 2 months. So you buy the car that has a street value of 100. Europcar buys in at 70, and they agree that for every month they keep them, they can sell them back at 69, 68, 67, 66, and so forth. This is a built-in cost of goods sold, if you will, plus the financing. Mm-hmm. So if you see in the balance sheet of Europcar, you see low leverage in Q1, because who needs a rental car in Q1? And it goes up in Q3, which is the biggest quarter, and it goes down. So it goes with the size of the fleet. To manage this, the OEMs in Europe invented the buyback model. They said, We don't want a system like in the US where you ship the car out to the rental company and then they sell it off to an independent dealer, and then the prices in this becomes a residual value game. In Europe, the OEMs in Europe want to control the price of all cars from birth until 6 years. And they do this by gaining market share by selling to the rental companies, in Europcar particular, and Sixt as well. And they say, we buy them back because then we can sell them at our dealership and then we can better control the prices. So this is a major driver for this business model, and thereby it becomes a much less risk compared to Avis in the US, which have, if I'm not mistaken, they have less than 15% on buyback. And that's why when they collapse in the US, it's always because that they had too many sedans and the Americans, they wanted only SUVs when the second-hand market collapses. On your question regarding Sixt, Sixt has a different business profile. They are more into corporate leasing, basically. They're more into premium segments. And thereby they have higher margins versus the low-cost model, which is one with more volumes around. And then they have less leverage on this fleet leverage. They have basically more equity in their business. And this is the thing that is, I think, not well understood by the market, that the headline leverage of Europcar is not real leverage, because this is leverage you can hand back. If you hand back your cars, the leverage disappears. But the performance differential between Sixt, that has been a real darling, and they do very well, it's a fantastic company. I think that trades at, if I'm mistaken, 25 times PE, and Europcar trades at 8.
Yes.
I'm not suggesting that Europcar is a 25 PE business. I don't think so it is. But it is certainly not an 8 times PE. And on the current earnings, with a 30% payout ratio, you get a dividend yield of 5% on a 30% payout ratio. So the free cash flow after everything has been paid, excluding the dividend, is substantially high.
I promised myself not to talk in a too excited way about Europcar this
sorry.
year, because if I need to come back next year or somebody wants me to
Then
come
I
back,
can be here alone.
Thank you. That was like a really very good explanation. Just one: is there a risk that this ends because the risk is transferred to the asset of the OEM producers? Then, if I understand good, is there a risk that if they get pressure that they change it like to the model in the States? Do you see this?
That the OEMs in Europe should go to.
Well, I think it's again a matter of if to change radically the system, it's a matter who has the power, the negotiation power. And currently, as Europcar is the biggest buyer from the OEMs, they have quite a strong position on the negotiation table.
Yeah.
But that said, 2018 is still a transition year. And due to these acquisitions, accounting-wise, it has been sometimes difficult for analysts to understand exactly on a quarterly basis what's going on. But we are quite confident that the investment case is still valid. We see no reason to sell the position.
It's a topic we have discussed with the company, saying what is the trend in this? Do they want to have more or less buybacks? The OEMs, that's basically your question. And the OEMs say, no, we want more buybacks, because then that puts them in a better position to control the second-hand prices. What they are really pushing is to say, can you please buy less diesel cars and more fuel cars? That's the only difference.
Okay, I think I'm next. Thanks for a great presentation, very interesting. On Krones, I was just wondering, you talked about You talked about a price war, or at least somewhat of pricing pressure. So I was just wondering, the pricing pressure on new orders, does that filter through also to the pricing on service contracts?
As far as we can see, no. It has been on the original equipment in the times when there's been a lot of management changes on the two unlisted competitors. There's been a lot of management change there. And it has all been a game of market share, because who would not want to steal market share away from the guy who has 24%? So big egos involved in this. We have not seen a pressure into from our conversation with the company. They are not fully transparent on it,
Yes.
but what they say on the equipment is where they have the price list and where they have added the 4.5%. It's still a game of the installed base. We have not seen price pressures on the services.
Most capital goods companies are not first tooting their service part, because that's obviously a big making the investment case for them, and they are usually quite opaque to give exactly the numbers, also for competitive reasons, right?
Any other questions? Okay, then I would like to thank Léon and Allan. And oh, we have another question. Sorry, I didn't see you there.
There was one.
Sorry.
Hi. Just a quick question. What would be your exit strategy? Do you sell a position as soon as it scores below average on quality or on value?
No, the screening is just meant to find new ideas. What is really determining our exit strategy is the fair value. We sell when our fair value is reached. That's the exit strategy afterwards. So in our model, we find the fair value in kronas. We follow that. We have our risk manager. He's actually the guardian of all the fair values, backed up by the models we have designed. And then once fair value is reached, the margin of safety has closed. If everything went well, of course, and the investment case have not changed, then we sell. But we are not selling based on this matrix. You have, if you look at our current portfolio, you have companies that are not scoring on the upper right corner for different reasons. The only thing which is very important for me is that we are able to understand why is the score not so high. And there may be, as in the case of Europcar, a valid reason which is part of the investment case.
Any more questions? I didn't forget anyone. Okay, then I would like to thank Léon and Allan, and thank you.